and consulting, operations, and hedge fund as well. And then outside of WIG and some of the things I do at Wesleyan, I used to play football. Unfortunately, our season is no more, so I'm somewhat retired, but happy to pass along to Christina.
And I'm Christina. I'm a senior here at Wesleyan, majoring in economics and Italian studies. This past summer, I interned at JP Morgan in San Francisco in wealth management, and I'll be returning there after I graduate. And then outside of Wesleyan Investment Group, I am also the co-president of the Wesleyan ACLU, and then also I'm an editor on the Italian magazine on campus.
Great. So a bit of an agenda, what we're doing here today. We have a lot of content, which is awesome. We're going to start with a pretty broad overview of how we kind of read markets on a daily basis. And then we'll go to an alumni speaker. And then we will finish up with some trade ideas, kind of bringing together the market stories and how to read markets into tangible ideas. So with that, so just some basic market sources. This is one of the ways I every day kind of get the gist of what happened overnight. So I think a great place to start for really the freshmen and sophomores who really haven't had much experience in markets is start with newsletters like the Morning Brew or the Daily Water Cooler. These are very simple, easy to read and quick reads, and you're not going to dedicate 30 plus minutes of your morning to reading markets because of school, athletics, or the arts. So something quick and easy to digest, like these two sources, are great. And then you can kind of move over to the Wall Street Journal. It's a little more sophisticated than the first two. I know at least at Wesleyan, the Wall Street Journal is free through Wesleyan. So that's a great resource for our students. A really good publication is Matt Murray's 10-point plan. It gives a summary of what happened overnight in Asia, the open in Europe, and how midday trading is going, and then pre-markets news in the US. So it's a very good broad overview while bringing together some more technical knowledge that's not found in the water cooler or the Morning Brew. And then you can, the next Wall Street Journal newsletter is a markets newsletter, and that's way more technical, I would say, than Matt Murray's 10-point plan. It's less macro, more micro. So, and it covers pretty much every asset class there is, which is really cool if you're interested in one of those specifically. So that's kind of the Wall Street Journal, and those will probably take you like, maybe 10 to 15 minutes to read in the morning just to get a sense of what happened. And then another newsletter is one from Axios, and I personally, this is my favorite because it's the most macro themed, and coming from Wesleyan, right, economics major, not a finance major. I'm used to kind of the larger macro themed stories rather than something very technical financy. So that's been very good to read every morning as well. And then at night, it's like a 5-minute read. It's one of the Bloomberg evening briefings. Another great source just to kind of complete your day. So you start learning about what happened in Asia and Europe, and then throughout the day you get US markets news, and then at night you kind of just like recap everything and wait for the Asia Open. So that's just a good way just to really build your base, and this kind of transitions to the importance of skills or for reading markets is so I'm in S&T. I can't really speak directly to IB or another subset of finance, but you're going to need to know what's happening on a daily basis if you want to do a job like that. And like literally every interview question, it will be related to markets and your markets knowledge. And the best way to start is really just to read those daily newsletters and to really build a pyramid of knowledge. And you want to start with a really wide base. And then as you get towards the top of the pyramid and start refining some of your skills, you will get more technical. But the important thing is just consistency. You're not going to read 30 minutes a day to start. That's just not probably going to happen. But it's just dedicating at least 5 to 10 minutes each morning just to set a good trend. And then, so that's great for interview questions as well. And then we'll finish it off later on when we talk about trade ideas. But you should be able at some point to look at a piece of markets news and be able to relate that to a specific trade, right? Because I mean, just like looking at news and just like saying, oh, that's interesting, but not put any money where your mouth is, it's irrelevant. You want to be able to show that in a job setting, you're able to add value and you're able to generate ideas. And that's what you do when you read markets. You see, how does this market story affect euro dollar or cable or German bonds? Like there's so many different right answers and different ways to make money that it all just starts with just reading markets. And then more sources. This is kind of where, like, like reading before you go to bed. Liar's Poker is a favorite of mine. Michael Lewis is an extraordinary writer. Blindside, Moneyball, The Big Short, like very, very famous feature films along with books. And they're just great reads. Another one, Barbarians of the Gate, that's less markets and more in the banking and transaction side. A very good book as well. And then All the Devils Are Here, in relation to the most recent financial crisis. So yeah, I think you should always supplement your daily news, which could be, you can construe as like mundane at sometimes, with some very lively books that really show you why this is such an interesting field to go into. My other WIG colleagues, do you have anything to add here?
No, I would say, generally speaking, diversity of sources is important. When you look across the landscape, you'll see one interpretation that varies from another, and ultimately that's what comes down to kind of diversifying your opinions and getting your information. And then with that, I think under the more sources, there's so many awesome books out there. These four outstanding. Barbarians at the Gate is one of my favorites. But I think really, when it comes down to it, consistency and diversity are incredibly important as you begin to take in sources.
I'll also say, if you're not a reader and you like to just listen to stuff on the go, there's like so many great podcasts to listen to. I listen to the Vital Dawn podcast in the morning. Also, Your Money Briefing by the Wall Street Journal. Also, What's News, Wall Street Journal. I mean, you could get the same and just as great information from podcasts as well.
Great. So now we're going to kind of change it up a little bit. So we're going to go to our guest speaker. So we recorded a great interview, I would say, with one of the most with a recent Wesleyan grad, Drew Myers. He graduated in 2020, and he's working at UBS in sales and trading, focusing primarily on rates and FX, G10 rates and FX. And he's had a very interesting experience, as you can probably imagine, in the sense that he started, I think, the first week in March of 2020. And I mean, all of you should know, like, obviously with COVID and everything, markets just blew up then. And a lot of circuit breakers and a lot of weird stuff that was happening. And he adds a lot of great color to it. He's a very interesting guy. He's from Boise, Idaho. He road crew with me, so that's how I knew him. And yeah, he's a very, very smart guy and adds a lot of insight into markets and his job in general. So we'll go to that now. If there's any issues with the audio, just let me know. Great. So very happy to have Drew Myers here today. He graduated Wesleyan in 2020. He was an economics major, applied data analysis minor. He's on the crew team at Wesleyan 4 years, and now works at UBS as an analyst in sales and trading in rates and FX specifically. That's very general. Drew, if you just want to add a little bit more about who you are, I think that'd be awesome.
Yeah, of course. So I graduated in December of 2019, so a little early, kind of got out there. And I started in March at UBS on their FX execution sales team. So it's a hybrid team that deals with both FX and rates. And our job is client coverage, execution in the market for clients, facilitation of orders, and then just broadly, giving clients information, color, thoughts, general market thoughts on their positions and how to best interact with the market. So it's kind of a broad role. You're both handling orders and execution. You're writing color. You're following the market so that you can be up to date on where your client positions are. So yeah.
Great. Yeah. So this whole topic is how to follow markets. That's why I thought you'd be a great person to have. So can you just talk briefly about, so going into the office every day, obviously you go in before equity markets open, American equity markets open. Can you talk about what you do for reading when you get to the office?
Yeah, absolutely. I think that the way that I approach markets is always kind of a top down. So I think that it's best in the mornings. I always start general. I look to see where basic asset classes are trading, right? So I like to look and see how risk is performing overnight, because that's going to give you a kind of sense of the tone for the day, right? So I'm going to look at how overnight equity futures are trading, right? I'm going to look at how European stocks are performing. I'm going to look at long end yields, so usually 10 and 30 years. And then I'm going to look at some of your classic risk benchmarks, right? So, the VIX, if it traded overnight, because VIX are futures, so they can trade them. And then, S&P futures, and I'm going to look at kind of your benchmark currencies. In my case, that's FX. I'm going to look at, the euro, the yen, and then maybe overnight dollar CNH is a great risk proxy, right? Because what that's going to do is it's going to set the tone for what investors are coming into the day looking at. And with that kind of broad overview, then I'm going to step back and I'm going to say, okay, so then what are the drivers today that I need to be looking at? What came out overnight? What were the headlines? What data comes out today? And kind of what's the expectation there, right? Now, the markets are going to price in what the expectation is, but it's always good to have a sense of what's on the calendar, because if there is a surprise to one side or the other, that won't be priced in, and you can see the markets move off of that. So I like to kind of get in the very early morning, just take quick stock. So I just pull up a few charts. Last summer, I was an intern. A great way to do that is TradingView. It's free. You can pull up charts and you can make a little chart screen of like the 5 or 6 benchmarks that you want to follow in the morning. Once you get that kind of sense, there's a couple different options in terms of like a morning newsletter to take a look at. I like the Daily Shot newsletter. It's free. It's 5 charts every morning that are kind of summing up what the market is looking at. If you want a little bit more of an in-depth read, Morning Brew is a great one. Honestly, Morning Brew is kind of a read. It's like a 10-minute read, and that's oftentimes more than I just want to skim in the morning, because I want to dive into my market in particular. And then, once you get the basic sense of it, I recommend you just start taking a look at how specific stocks or currencies or whatever you're trading are performing, right? The key with markets, in my opinion, is to just always have a sense of where they are, right? You want to be present with them, because markets are going to trade differently. Certain asset classes trade differently on different days, right? And it's really kind of it's building an understanding via familiarity. So some of the best advice I had was just watch markets, watch headlines come out, and watch how markets behave off of them. And so that's kind of like in the morning, if you just, in under 15 minutes, you can get a quick snapshot of the market and then come back in at the end of the day and see how they finish, right? You can really do this via only mornings and evenings and just see how things progress over the day.
We talked a little bit before about how you like go about your critical synthesis of information. You talk a lot about like how it's always a quick read. You alluded to the Morning Brew being a little bit too long. You need quick, because you need to make quick decisions. Can you just elaborate more on that about your synthesis and the speed of it?
Yeah. So I think that the biggest thing that you want to kind of get away from, in my opinion, is you want to get away from the idea that you have to, you don't want to have to take up a tremendous amount of your day. There's a lot of stuff in my role. There's a lot of things that are coming in. You want to be able to see things and process them quickly. Now, if you're following the markets as more of a long only strategy, then reading more is often better. In my case, it's a little bit different in my role because it is so execution driven, and you want to be able to see information, process it, and internalize it so that when you see asks later from clients, you're able to come back with good information. That's specific to the S&P world, right? Where a client may come in and say, hey, why is XYZ trading this way? And if you're able to, quickly take in information as it comes up, just see things that are coming into your feed, remember them, internalize them, then you can answer that question a lot better. And you might be able to provide something meaningful that will get a client to trade on it.
Gotcha.
And I guess the other thing I would say, I followed markets a lot before I got into this role. And I think that one of the biggest things, the reason I say make it quick, because if you're saying, I want to take an hour every morning to see the market, you're not going to follow through on that for very long. 30 minutes in the morning, that's still a while. But if you can get it down to 15 minutes in the morning and 15 minutes after the market's close, maybe even when you're going to bed, just be like 15 minutes when I wake up, 15 minutes when I'm going to bed, just be like, okay, what did I think was going to happen today? What did happen today? What's going to happen tomorrow? And then just repeat that. You're committing about 30 minutes to your day. And that's something that's very easy to do.
Before you were in the role with FX and rates, and you talked about looking at charts, for people who are like freshmen or sophomores, what are just some good metrics just to keep in mind when just looking in the morning, just in general, just getting a good feel of where markets are at?
Yeah, that's a great question. It depends on what you're looking at. I always like to look for kind of where a market's behaving versus the previous 5 to 10 days maximum, right? Because in a lot of cases, especially in FX, those markets are going to be very technically driven in terms of like, there's going to be resistance levels. There's going to be critical levels where the market will bounce off of them, or there's going to be supports where the market will bounce off the bottom side, right? I like to take a look to see if we're close to any of those. And I like to see kind of where the trend is, right? If you see a market that's going up and down, but it's trending down, look at the last 10 days. Is it grinding down lower? Was there a sharp drop and now it's just trading flat? Those are sorts of things that, like, you don't have to get into the whole like candlestick charts. You don't have to look for head and shoulders patterns. You don't have to dig into the technicals. Those are valuable if you want to provide specific color, if you want to take a look. But you know what? In my opinion, those aren't really like any more substantial than saying, okay, here's a technical level. I look back at the previous 10 days, we bounced off this level. I look at the past month, we bounced off this level, right? If you don't see any trend over the previous 10 days, look back a month. Typically, markets aren't going to look back more than a month for those sort of levels. And like, just getting a feel for that. Now, I don't recommend you do that for everything, but for your benchmark indices, maybe take a look. If you're following specific stocks, definitely be taking a look, right? If you're, especially before you go into a stock, say like, oh, I'm looking at this, when is a good point to buy? Well, if you see it approaching a barrier where it's bounced before, that's a great opportunity to get in, right? If it's bounced off that barrier and you see, say, treasuries, like yields are going up and futures are going up and that stock has bounced off a barrier, that's a great opportunity to be looking for something. Or, those sorts of things where you're just kind of looking at how the general flow of the market is.
Yeah, no, that's great. I think that's a great answer. Just a good sense of just some like technical, but like very, very high level. It's good as a young person.
It's approachable when you look at things from like a short-term, no, it's approachable when you look at it from that perspective, right? You don't want to think about everything in terms of like, technical trading. Like, yeah, you can throw up like a very simple mean reversion graph. So you're just looking at like when it's breaking outside of the 2 standard deviation range. Those sorts of things are very simple and they're like very easy trading signals. But if you're just looking to get a handle on markets, if you're just trying to have a general snapshot of them so that you can go into the day saying, okay, yeah, stocks are generally trending up they were trending up this morning. We had a couple things on the calendar, and then you can finish your day and saying, oh yeah, no, they finished up or they finished down because of X, Y, Z, right? That's, I think, the biggest thing. It's like going into the morning, say, yeah, so here's where we were trending in the morning. And then at the end of the day, do a post-mortem and say, yeah, this is where we finished because of X, Y, Z. Here's what I expect tomorrow because of, the next thing.
Gotcha. And then, so going from Wesleyan, from like a generalist liberal arts background and going to UBS, what was like the biggest change in the way you followed markets from Wesleyan to UBS? Yeah,
I mean, obviously the biggest one for me is just the depth with which, I go through things. My morning is about the first thing I do for about 30 minutes in the morning is I get a handle on where everything is trading that I need, right? So I have my top 15 currency pairs on charts static on my screen where I can follow them exactly. I check the overnight headlines. I see exactly where things are coming in. I chat with traders to get a sense for it. And it's about, I mean, I think the biggest change is just the depth, right? The depth and in terms of like how far into the market I'm going to go. I'm going to look at where currencies are trading. I'm going to look where futures are trading for stocks. I'm going to look at where, you know, volatility is trading across different currencies. I'm going to look at who's buying versus selling, right? These are things that you can't really get information from unless you're at a bank, because, you know, a lot of what you can actually do at a bank is see a lot of volume. That's some of the biggest value that you get sitting at a big investment bank. But, you know, I'd say that like, that's a big thing that I had to kind of transition into, is just like, yeah, I'm taking maybe 15 minutes more than I spent at Wesleyan, but the amount of information that I'm cramming into that in order to get a clear picture of where a market's trading is way higher.
You don't need to go into too specifics about this next one, but what was a time when you had a trade idea based on some piece of market information and it was just completely wrong, and kind of how you learn from that?
Yeah, man, there's a lot of those cases. So well, you just got to kind of realize that sometimes curveballs are going to come in, right? The best technical analysis can get derailed quickly by a piece of news, right? So I actually think a really good example was last week with Trump's tweet about the breakdown in vaccine headlines, right? Or the breakdown in terms of stimulus talks, excuse me. The breakdown in stimulus talks, you know, the trades that I had conviction on there in terms of like where I thought, you know, I had been talking with a client overnight or in the morning, excuse me, that morning about where I thought a specific currency was going to go. I was saying, oh yeah, I think that this is going to go a lot lower. And then that headline came out and all at once skyrocketing. Right now, the guy didn't trade on it. The guy wasn't, you know, he knew that market well. It was just kind of a friendly conversation. But, you know, that's kind of the thing, that things can move on a dime, especially especially for me in FX markets. So they can really move. You know, fortunately and unfortunately, a lot of the trade ideas that I talk to people about are more general at the moment. It's a lot of kind of market color. But even last summer, you know, we had a trading simulation that we would go through as an intern, and you know, I was watching. I think last summer I was watching dollar CAD, dollar Canada, trading lower for a while, and it kept bouncing off these technical supports, and I kept thinking this will be the one, so I'd buy it. And it would blow right through and I'd lose another 80K, and it would just keep going down. I'd be like, okay, well, this might be the one. I'd buy another 50 and then I'd stop out of it and, you know, lose another one. And I just dug myself into a hole doing that until I started thinking about it and say, you know what? This thing isn't doing what I expect it to be doing, right? And that's my bad. That's not the market's bad. That's my bad for thinking that it's going to behave in a logical way. Sometimes you got to take a step back and say, okay, I think it's going to do this. It hasn't done it twice. I'm not doing it. I'm stepping away from this market. I don't understand it well enough. I don't know what's going on here clearly, so I'm not going to engage anymore. And that's sometimes the best thing. Sometimes if you don't know, the best thing you can do is say, I don't know. Step back. Find somebody who knows a lot better. That's a big thing that you'll learn. If you go into this industry, the first thing, you can have a lot of ideas, but sometimes you got to just say, I don't know, let me find somebody who does, because there's stuff that you're just not going to understand.
Yeah, that's a great point. Just like sitting back sometimes when you don't have the conviction and just like letting it play out. So going back to like with freshmen and sophomores in college, do you think just like if they've never followed markets before, the best first step is to subscribe to like a morning brew, for example, and just like get some sort of build some sort of markets knowledge initially, or what else?
Yeah, you know, I think the morning brew is great if you can consistently read it. For me, I really think that the best thing you can do is just glance in the morning at a few different things, right? And you want to know kind of what's coming up. Like, I think the biggest thing that you can do that will keep you engaged with markets is the look forward, right? Markets are forward looking always. They don't trade off of things that already happened, and they price in things that are coming in the future, right? If you know that something's coming, markets price in something about it, right? So, for example, next week, there's an EU summit, right? Markets are pricing in certain outcomes from that EU summit, right? If those outcomes aren't met, things are going to move, right? So I think one of the biggest things you can do to get yourself into a good routine is say, okay, just on Monday, take a look at a calendar. FX Street always has a great calendar. Look what's coming up. Say, what's going on? What's kind of the expectation? If any one of those things catches your eye, do a little reading on it. See what happens. See if it trades like you're expecting it to. Take a stock, look at when earnings are coming out, look at stuff like that, right? And then you'll start to build kind of like a casual familiarity where you're like, okay, so on Monday mornings, I just check a calendar, right? And then I kind of follow up to see how things happen and if anything moves. It's a super simple process, but it's actually kind of, by looking forward, you're locking yourself in to go back and check on it later. And then eventually you'll kind of get into a good habit, right? Reading the daily shot in the morning, that's a great one. It's just 5 charts. You're just looking at it, you get a good sense. You can talk about something in the morning to people and just be like, yeah, you see this number came out, you see, there's a lot of this information. It's just finding the little things that'll keep you coming back, right? Because I think that's one of the biggest things that I struggled with before I kind of really just settled on this as a career path, is like, I wanted to follow markets, but I just kind of couldn't stick to the like checking it daily. But when I started looking ahead at things, I started looking a lot more.
Gotcha. And as we wrap up here, I just wanted to hear more. What got you into markets as a whole, and like what was the catalyst there, and kind of what makes you stick it? Yeah, there's a lot of things, but I think one of the biggest ones was a speaker at UBS when I went. I knew kind of that I liked the idea of following markets. I liked the idea that you're always kind of on your toes with like information coming in. But there was a speaker who came in when I went to a recruiting event at UBS. And basically, he was like, he was an equity. He was the head of equity research at the time at UBS, I believe. And he basically said, do you want to be the kind of person who is prescient and current and very topical every day? Do you want to be the guy who knows what's going on in the world? Do you want to be the guy who can talk about anything that's coming up, any political event, anything around the world? Do you want to be the guy who understands that and can speak to it and can understand it with a level of familiarity that most people never would? And that to me was something that was so appealing, to be able to just have to be dialed in to, the broader, to just broader global events, right? To have a job where your job is to constantly be learning, to constantly be taking each scenario, analyzing it, thinking about it, and being able to try to come up with something that is actually not only interesting, but marketable, where you can turn that into dollars in your pocket, right? Or dollars in your client's pocket. That sort of thing was just inherently appealing to me, because there's never a dull moment. There aren't dull days in the market. There are days that are slow in terms of client interest, but why are they slow, right? You can look at those sort of things, what's going on in the background. The people who are putting trades on in slow days, those are often the most interesting, because those are things that are completely separate from a slow market. If you're putting on trades in a slow market, that's really interesting to me as well, right? There's always something to be found in markets that is always interesting. And to me, that's the kind of thing that I wanted. I wanted to build a career where it's entirely built on, what's happening today and remembering what happened a year ago, so that I have a full understanding of how the world is progressing. Yeah, Drew, that's an awesome answer. I think that shows why you like talk to clients every day and like can sell them things, because that was spot on. So very, very last question. We talked before the analogy of the hunter versus the farmer in regard to sales and trading versus investment banking. Can you just elaborate on that a little bit? Because I think it's a very good analogy. Yeah. Look, and I said before, there are elements in each, right? Yes, in sales and trading, you cultivate relationships. You put in a lot of work over a long time so you can yield better results in relationships. And you know what? In IB, yeah, sometimes you got to go out and find a client and really sell them on it hard, right? Sell them on a deal so you can get it done. That being said, on a day-to-day level, I would say that comparison is apt, right? Your day-to-day work in sales and trading is much more, you have to be on your toes, right? You are getting requests from clients. If you're on sales, you're getting requests from clients in and out, right? You got clients coming in asking for price. You got clients coming in asking why something isn't moving when they thought it was. You got clients coming in asking if their order was done, and if it wasn't, why. They're asking questions about the market. You have to be, and on top of that, you have to be on the front foot, because you want to be relevant to your clients, right? So not only are you
playing defense. It's block and tackle whenever anybody comes in, but you got to play some offense too. When you see a headline coming in, you want to be putting that in front of your clients who will trade on it so that you are relevant to them. And that's what it's like to be, that's why I would kind of compare it to a hunter, right? You're constantly on your toes when the market is live, because if something comes in, you want to be the first guy who puts it in there. You want to be the first guy who says, hey, you see this headline? I think Sterling's going to pop on this news, or I think the S&P is probably going to take a hit here, or I think tech is definitely going to rotate down today based on this headline. And you want to get your clients interested in the trade. Whereas in IB, on a day-to-day level, you're putting in a steady grind of work, right? You have an end goal for a client who has a request, right? You have a request to come in here. Let's say you have an IPO, right? You got to be out there marketing on a road show, or let's say you have an M&A transaction, right? You got to be building an appropriate model and then sending that off to be reviewed. They're going to send back comments. You're going to review it again. You're going to send it back, right? Those sorts of things are very much like a steady process working toward the final completed goal. Whereas, the end goal of the day in S&P is to make some money, right? If you're a trader, you want to be trading. You want to, you got to be watching the market because you got to watch your position. If you're a salesperson, you want to be getting some client flow in there because that's how you make money for your desk, for your team, for your bonus at the end of the year, right? But, I think that's just where it's apt on the very day-to-day level is, do you want to be a long-term thinker where you're modeling, you're crushing out, the technical details of something that's very holistic and complete? Or do you want to be here and then you want to be here and then you want to be answering a question, you want to show a price and you want to get some color and you want to show somebody else some color and you want to write something up that's going to be important in a week's time for some clients, right? That's where it's a little bit more scattershot, which some people isn't appealing to them. But if you like that kind of like broad-based, never a dull moment, that's kind of how I would construe it.
Awesome. And just very last thing, any advice for people who want to break into sales and trading or market specifically?
Yeah, a couple things. One, just be passionate about it. Just like really start to like, if you can keep up with it and start to follow things, that's huge. Read books about it. Get to know some things. I recommend More Money Than God. That book is awesome, right? Looking at what those guys did, chapter 4 in that book, I believe, it's about Soros and Druckenmiller breaking the Bank of England. When I read that the first time, I was like, damn, these guys were awesome, right? I mean, these are two guys who basically single-handedly broke the English currency, like the British currency system, right? They broke the Bank of England. He made $4 billion that morning, Soros' fund did, right? Just by putting an immense amount of pressure. That was two guys and one fund who broke a central bank, right? I mean, these are the kind of things that you can do in markets. Now, yeah, that's maybe there's some ethical concerns about, going in and like massively devaluing an entire country's currency. But the point is, these guys had conviction and they stuck to it and they made it happen, right? And like reading books about these things is great. And I think the other thing that I would really recommend is just take notes and start building a long memory. I could show you my bookshelf. There's a stack about this high of notebooks, look just like this, right? Where I have taken notes on so many things in markets. Now, obviously you want to get to a point where you can just remember it, but start building a long memory, right? If you follow 5 stocks, remember how those stocks trade, right? The first stock I ever followed was Palo Alto Networks when it was tiny, right? It's a little software company that was starting out in San Francisco. And basically they were like providing data security to some of these startup tech firms. Now that stock is just it shot straight up a few years later, right? And now it's a massive player in that space, right? That's the first stock I ever really followed. I don't know why. It was kind of just one that caught my eye. There was some headline on Yahoo Finance and I was in like, I don't know, when I was maybe a sophomore or junior in high school, right? And I still follow it. I still check in on Palo Alto Network. So building a long memory is what makes you good in this business. The guy who sits behind me at the office now, that guy's been doing this for 27 years. When you talk to him about a month in, he's like, yeah, no, I mean, you look at the performance across the board and like these indices, I think the euro is probably going to hit here. Over 60% of the time, he's right in terms of the interest, right? Just because he has a memory of how things trade. He knows how it was trading over the month. He knows how it was trading last month, right? He knows how clients are going to behave around certain events. That's the kind of thing that like only is built by, one, being committed to remembering and following markets, and two, just, making sure that you internalize the things that you see, right? It's not everything that happens you should try to make an effort to internalize it, because it all kind of comes back, right?
Awesome. Well, thanks again, Drew. Really appreciate it.
Yeah, hope that was helpful. Again, Marty, send out my email. I spoke to somebody last week.
Great.
Who had a super day, trying to get as many Wesleyan people as I can. So
Great.
If you've got interest in S&T, reach out.
Awesome. All right. Thank you, Drew. Appreciate it.
Yep.
Yeah. All right. Well, that was Drew. Obviously, he is very passionate about markets and sales and trading, and just a really good resource for Wesleyan to have. And I assume at other schools you have individuals in similar seats with similar drive. So this is kind of a tangential point, but really rely on your networks at your school, because you'll find some great people there who will help you get jobs and progress in the future. So with that, we're going to go ahead in our presentation and really try to bridge the gap between markets news and color and trade ideas, which is what Drew was talking about. So with that, I'll kick it over to Julian, who will talk about Gamestop.
Sure. So really interesting news I've been following for quite some time, just given sector rotation as well as the intrinsic interesting nature of GameStop. They recently announced a partnership with Microsoft, and this caused some massive movements in the market that always tend to catch the eyes of people like myself, Andrew, Christina, and Griffin, as well as some others in the room, I'm sure. And so from a really high level perspective, what you're looking at is a retailer in a struggling sector, and they're seeing revenues decline. And that's really what's occurring from the highest 10,000 feet level. With that, whenever that occurs, there begins to have conversations about operational efficiency, SG&A, and kind of, in this case, what would be real estate impact on balance sheets and income statements. So that's 10,000 feet in the air. Driving down to the news level of what happened, they announced a massive partnership with Microsoft that caused an intraday trading halt. And these are very infrequent, particularly of a company of the stature of and kind of brand awareness of GameStop. And so we saw a 40% increase, which you see in the top right quad, that pushed to 45, I believe, by close of day. And so this partnership with Microsoft was read into the news as largely a very positive thing for GameStop, as indicated by the price movement. And it's largely speaking, a lot of benefits for Microsoft. When you actually read into the deal, it's very clear that Microsoft seems to be getting the better end of this, reasonably so. They're a larger company with a lot more of a backbone than a GameStop. So for example, it's basically them putting services and their back end into Microsoft's retail business, GameStop's retail business. And then looking at the finance side of GameStop, we're seeing massive revenue declines. Like I've mentioned, we're seeing EPS being negative over the last 2 years. We're seeing a push towards e-commerce, obviously, given the circumstances of coronavirus and the pandemic. And we're looking forward to a holiday season where there's massive competition between Sony and Microsoft as it relates to their new consoles coming out and shipping. To give a little bit of perspective, Q3 for GameStop is going to finish up in late November, as it's estimated today, probably thinking 25th through 28th. And we're seeing that Microsoft only accounts for a really small portion of GameStop sales. And so they're going to get this partnership with Microsoft, whereby they're going to have almost exclusive access to this package by which people who buy an Xbox, the new Xbox, can get 24 months kind of free of their online program. And then jumping back up to 20,000 feet, in this sector, we're seeing massive competition, as we are with most retailers, between Amazon, Walmart, who's really pushing e-commerce heavily, Target, Best Buy, etc. So GameStop is having to accommodate to these almost insurmountable competitive pressures by cost cutting, right? And so this is something that's familiar to me, which is that oftentimes when you have a large body of real estate as a retailer that's declining revenues and declining EPS over time, you have to begin to sale lease back or restructure a lot of your real estate. And so what's happening here is they're taking SG&A and just constantly trying to chop it down. And the question is whether or not they can really be solvent and liquid as time moves forward, given the increased competition. So it's a race of how low can you get SG&A and how pause can you get revenues to move over time. So that's my liberal arts take on kind of what's happening here. As you can tell, we're definitely slanted towards that macro idea. But moving on to the next slide here, the general trade idea is there's a lot of tinder, right, in the fireplace. It's not hard to imagine there's a ton of tinder, whether it be the financials, whether it be the real estate, whether it be increased pressure. And I look at the situation as there's enough matches here that one of them could eventually spark. Questioning when or how and what's the best way to position this. So I'm going to talk about one way, but I also want to tap into a few others. So we're on the line here. If you were CEO of GameStop, you're on the line for $500 million in long-term debt. And you simply do not have the cash flow to finance that over a long period of time, even with a partnership, for example, which investors thought that would cause the market valuation to jump 45% in one day. So they've acknowledged this massive risk. They're beginning to do sale leasebacks on properties to create cash. If you're unfamiliar, essentially you're taking your real estate body and you begin to sell it and then lease back, hence the term. So you're actually leasing the property and you generate cash in the short term. It's not something that's terribly uncommon, but it's another way to kind of utilize your resources as a retailer given the circumstances. And so historically, we've seen them trade at a 4 to 6 PDE just to keep it really high level. Right now, we're seeing them trade at a 40 times PDE. So if you thought that the Microsoft partnership was important, I think it's really vital for us to examine, is this worth 40 times price to earnings given that they're a retailer, period. It really stops there. But kind of looking a little bit further, this is a dramatic shift and an implication of massive revenue increases, earnings, and cost cutting all working out in their way, which I just don't see as a terribly likely situation given the increased pressure from competition. So Jefferies took a pause at GameStop's valuation, and I just kind of wrapping it all up into kind of one thesis, I would say, given the short-term volatility, large debt load, real estate issues, solvency concerns, and a possibility of even this being a dead cat bounce, it's our view that GameStop could struggle over the next 12 to 18 months, just given that it's probably not worth 40 times price to earnings. So a bunch of different ways to play this. I've been told, I do appreciate short selling quite a bit. I've been told that professional short sellers actually don't mind shorting a stock as it moves from $1 to $0 as much as they mind it moving from, say, 15 to 0, as the profit is intrinsically the same. It's still 100%. And it's not really theorizing that GameStop goes to zero, probably over the next 20 years it does, but not in the next 12 to 18 months. So there's a bunch of different ways to play it. You could short it today. And given that, if it moves downward, you're going to be pretty happy. I don't see it moving upward too much more. I mean, holiday season is definitely a potential risk, but there's still a lot of other catalysts and upsides as a short seller here. You could short it once you see the movement downward and like a significant $3 to $5 move downward and try to catch on to what could be the rest of that movement. You could set up some sort of straddle or an options trade, and I think that's totally fair and certainly could limit your downside risk as a short seller. But just to keep it pretty pure, if you were to short sell the stock today and it were to say to move to $0, you're obviously at 100% upside, but the reality is it's probably in a 12 to 18 month time period going to come back to a more reasonable multiple between 4 and 15, in which case you'd be making a healthy, say, 50% to 70% profit. It's really uncertain. What we do know for certain, though, is that the volatility is immense. So you're going to be having to withstand that. But at the same time, I'd look to a lot of the catalysts and risks as very timely and very projectable. So as a short seller, that's something that gives a little bit of a backbone to the trade. And it's something really interesting that we'll continue to follow over here on our end. I encourage you to do the same.
Great. Yeah, that was really good, Julian. So moving away from equity markets and into the interest rate environment, a trade I think that could be very profitable in the near term is a yield curve trade that is a 2-year and 10-year US Treasury curve flattener. And I'll talk about what that is in a second. But before I do that, adding to what we talked about earlier with resources, a great book to read is When Genius Failed. It recounts long-term capital management, which is a very risky hedge fund back in the mid to late 90s. And they actually failed in 1998, and they got bailed out by the U.S. government, the Fed. So it's one of the only times in history, when a hedge fund was actually bailed out by the Federal Reserve because they had such large positions and such an impact on the U.S. economy and markets worldwide that they needed to get bailed out. And the reason why I say that is because one of their biggest trades, or one of their best strategies, their biggest money-making strategy, was trading on the run and off the run U.S. Treasuries. And historically speaking, on the run just means that it's a newly issued U.S. Treasury at an auction. The Treasury issues these securities periodically through auctions. And what the trade is essentially the on the run bonds, the on the run Treasuries, they trade at a premium once they're newly issued, and the off the runs trade at a discount. So because off the run trades at a discount, you would buy off the run and sell on the run. And that's a very high level description of it. Read the book; it's a lot more detailed. But it was essentially all of that strategy just failed and collapsed on them. And it actually ties back to Liar's Poker, which was Michael Lewis's book that I mentioned earlier, because a bunch of those long-term capital management guys were from Solomon Brothers, which was Liar's Poker. And it's a crazy story with a lot of very famous PhD economists in this hedge fund and just going bust. So moving forward with this US, with this Treasury yield curve trade. So I like this trade because I think there's going to be a risk off move in markets, plain and simple. I think within the next 3 to 5 months, when we go through the election, and there won't likely be a clear decision come November 3rd, that there'll be a serious risk off move, because there'll be a ton of volatility, especially with the U.S. economy and the U.S. political system, I would say, in upheaval. So very broad overview right now on Treasury. So they're U.S. government bonds, and there's an inverse relationship between bond prices and bond yields, right? So like when bond prices go up, that means when demand goes up, yields go down. And yields are pretty much just the return to investors. So think about coupon payments, think about the cash flows, and the time value of money. Obviously, that's very high level, and you should definitely dig more into it if you're interested at all. And interest rates right now obviously are at historic lows because of COVID-19, economies in shambles. Even before that, right, you had negative rates in the EU and the rest of Europe. Even the Bank of England is pondering going negative as well. And those are nominal rates. So it's a very interesting environment with rates so low. So just at the top right, we see the U.S. Treasury, the Treasury yield curve. And what actually happened in March of 2019 is there was an inversion in the yield curve. And for those of you who don't know, the inversion of the yield curve is just when the longer term Treasuries have lower yields than shorter term set Treasuries. And what that tells you about markets is that investors are thinking that there's going to be a downturn because they are moving towards safety. There's a flight towards safety because Treasuries are theoretically one of the safest assets because it's backed by the full faith of the U.S. government. So that was just a little tangential point where in March 2019 there was a yield curve inversion. I again encourage you to look at that. But going back to here, so with theoretically in longer term Treasuries, they should yield you more because you're holding these securities longer, you're waiting for the payments longer, so you should get more yield from it versus like a shorter term Treasury. So a curve flattener. What I said, I pitched a 2s10s curve flattener. So what that is I am buying the 10-year and shorting the 2-year. And so essentially, if you're looking at the curve in the upper right, it's that the curve between the 2 and the 10, I'm saying that's going to flatten. And the reason why I'm saying it's going to flatten is because of the risk off sentiment, which I think is going to happen over the next few months, where investors are going to go to safety. They're going to buy the 10-year, and that's going to push down yields on the 10-year. And shorting the 2-year, so doing this curve flattener trade, is that spread between the two. I don't think that the 2-year or the 10 or the 2-year is going to go up or down too much, but it's essentially just mitigating my downside risk, because if I'm buying one and selling, if I'm buying one just straight up, I'm totally exposed to the downside. And if everything goes wrong, then I could just lose a ton of money, versus if I'm doing a flattener, a pairs trade, then I have some downside protection because I'm doing the opposite in a highly correlated market. Other things, yeah. So in yield curve trades, you want it to be DV01 neutral, and DV01 is a dollar value change for 100 basis points in a bond movement. And 100 basis points is 1%. That's just another good thing to know. And so this relates to duration. And again, for bond math and bond calculation, this is very, very basic. You should do a lot more research into how duration is actually calculated, like Macaulay versus modified duration. There's a bunch of different types of duration. Look towards it, look more into it if you're interested. And it's basically just the bond sensitivity to a change in interest rate. And so what it means to be DV01 neutral is you're saying with a one interest rate, with a 100 basis point move in interest rates, you're going to want DV01 to be neutral, because that'll change the price of the bond that you're long, and you want to have an opposite and equal movement in the other bond, so you don't lose any money from interest rate change. So you eliminate interest rate risk here. So that was a lot. Going to the actual trade. So, I mean, like I said, continued risk off environment. We've seen in the past weeks with a lot of big pharmas either pausing or delaying trials for COVID-19 treatments or vaccines. And obviously phase 3 should take years and years to do, but they're trying to achieve that in a matter of months, which is going to bring up a lot of issues. And then also investors want to see more quantitative easing that'll help boost markets or inflate equity prices even further. But it's unlikely the Fed will do that. Just like looking at some of the releases from Powell and the other governors, they do not want to raise the balance sheet again to around 7 trillion where it was in July. So it's unlikely that we'll see a lot more purchases in like high yield bond ETFs. Like that's just not going to happen, I don't think, going forward. So that will not help risk on environments like equity. So that's why I'm saying move to a risk off. And I do think so. Markets right now are pricing in a Biden victory. And if Trump loses, I think the transition of power, I mean, a lot of people are saying this, the transition of power won't be very peaceful and won't be immediate. There will not be an immediate concession. So as a result, I think that there's going to be a lot of instability in risk on environments moving forward, which is why I'm moving to the risk off trade. And then the 2 years relatively banded. I think over the summer as well, there was a lot of technical research saying the 2 years not really going anywhere. We don't see a big change in interest rates as it is. We don't think the US is going negative, nominal negative. So we think that the 2 years definitely banded, but we do think there's going to be a move in the 10-year. So that's essentially why we're saying there's going to be a curve flattener, and we think we'll take profit because of the election risk, because of COVID-19 risk, because of the Fed not doing any more QE, and a sell-off in like a bunch of overvalued tech stocks, I would say, an inflow to safe havens. So just the trade setup, whenever you do a trade like this, you want to ask a trader for the social size of the trades, like what's a socially accepted value. I said 100 million here. It's kind of an arbitrary value. And then how you do it is you set up a ratio between the security you're longing, setting that equal to the security you're shorting, with DV01 in the denominator and the nominal value in the numerator. So if you're doing 100 million in the 10-year, you have that in the numerator. You cross multiply. You solve for the other numerator to find the nominal size of the other security. 5-month trade, and then you also need to calculate carry and roll, which is beyond the scope of this, but important to know. Price target right now, I think, is 50 basis points. So 0.5%. It's trading right now at around 59 basis points. So that's a pretty significant move. But I think it's doable within 3 to 5 months. So that's it for me. I'll pass it over to Christina to talk about Pfizer.
Yeah, and really quick, I want to be cognizant of everyone's time. So we're just going to move through this really quickly. If you go to the market event, we know that earlier in this week, Johnson & Johnson, the drug maker, had to halt their trials because of an unexplained illness of one of the volunteers. And then the next day, Eli Lilly's phase 3 trial was paused due to potential safety concerns. And then last month, we had AstraZeneca trial halted over concerns of 2 participants who had fallen ill, where their clinical trials have continued in other countries, but in the United States, it's still, they still haven't continued. We know the role of the NIH and the FDA. They're really just trying to get these drugs manufactured as quick as possible, especially with all these new programs. And just as a little FYI, Eli Lilly, before the news came out that they were going to halt their trial, they were in phase 2. The results suggested that the treatment may reduce the risk of hospitalization, and they were seeking emergency clearance just the week before. And really the idea of like looking at this specific market event, it's something that's in our face all the time, right? We all want the vaccine. We're all trying to keep up with the news and see what's going to happen. As of right now, we know like the vaccine will not be ready until at least the new year, but more delays could happen, and this could push back the timeline with distribution. As of right now, if the drug comes out in the new year, the distribution would be 6 months later. And then there's a ton of other issues. How you get it to the entire population? How do you get the entire population to trust the drug and not think that there's political influence on the process and making sure that the drug is actually safe? And also looking at what's happening across the world. So there are already vaccines available in like Russia and China. However, experts are kind of raising ethical concerns. A lot of them haven't. Well, all of them haven't entered phase 3 trials yet. And so, it's essentially, is the effect, if it's really effective, and could it actually do harm to the populations that these vaccines are going to? So if we go to the trade idea, you kind of like take all of what's going in, that you're looking at Pfizer now. It's the last like biggest contender, not the last contender, but the biggest contender to have a COVID-19 vaccine. They came out actually just this Friday saying, we're going to push back results until mid-November, but they're already ramping up production. They committed to over 1 billion doses by the end of 2021. The US has already put in order for about 100 million doses, and then another 500 million doses, which is about $2 billion. And then they have deals with like Britain, the EU, Japan, but all of this production will not matter because if the drug is not approved, then all of these orders will go away, even though Pfizer is ramping up production. And so we talked about this rapid timeline, right? Well, if you look back at historical data, you see that taking a vaccine and developing it takes about 10 to 15 years, and we've crunched it down to less than a year. And in that process, 70% of drugs make it past phase 1. Of those 70%, only a third of them go to phase 3, and of those third, only 25 to 30 go on to be approved. So it's already a lot of pressure. In the past, it's been a very selective process. In this shortened timeline, it's hard to tell the drug effectiveness. There's a lot of concerns that the trials aren't accurately representing participant age, because I think a lot of older people are unwilling to kind of volunteer and continue with this if they know that they can either get the vaccine or the placebo. There's risk of underrepresentation, limited resources for actually creating the drug on a mass scale. The public trust is huge. I think a lot of, especially in the United States, a lot of Americans are very skeptical of is this a safe drug because of the political influence, because of this rushed environment. And then also a potential worry of, unwillingness to find further vaccine trials by the population, because once there's a vaccine, everyone will want to take it. And so whether Pfizer even gets approved, which there's a very there's a very high chance that they don't get approved. I think Pfizer's poised for short-term struggles within the next 3 to 6 months, dependent on all these factors that I just talked about. And so this would be just a straight short trade, looking at, critically of what it actually takes to make a vaccine, and then putting your money where your mouth is and seeing, okay, do you think Pfizer will actually deliver or not? This is just like one opinion, and looking at the data, this is where my mind go, but it's all about critically looking about what's happening in the news, and then putting your own spin on it. So if you think Pfizer's going to do it, I mean, obviously that's not a short trade, but looking at the information, this is kind of like where we're headed right now, in my opinion.
All right, I'm going to cruise through this because we're well over. But very simply, interesting company right now, given the rollout of 5G, is Crown Castle International, which is a leading provider in the shared communications infrastructure in the US. It's also one of the largest REITs in the industry. And right now they're trading at 167 a share. And what they do is they provide wireless carriers with the real estate they need to run their networks. So right now, the company's current portfolio consists of 40,000 macro cell towers in the US, which really serve as a backbone of the mobile communications network in the US. Also, they operate 70,000 small cell towers, which are backed by 80,000 route miles of fiber optic cables, which are completely crucial to the rollout of 5G. So these small cell towers are fiber connected antennas that sit on top of existing structures, say streetlights, utility poles. I think they're even putting them on roofs. Now, really anywhere, because their range is very small. So how Crown Castle makes its money is it leases space of these assets to leading telecommunication companies such as Verizon via long-term contracts. And these contracts provide steady cash flows, which currently are yielding a dividend around 3%, so around $4.80. Within the company, Elliott Management has a $1 billion investment in Crown Castle, specifically in its fiber optic business. And right now, Elliott Management is pushing to make Crown Castle's dividend increase. So they're claiming that 2/3 of Crown Castle's revenue and earnings come from its tower business, that's used to run the macro cell tower specifically. And the company is deploying 73% of its CapEx into its fiber business, especially to, catch on the wave of 5G. Elliott Management wants Crown Castle to shoot for a 40% ROI on its fiber spending, and they claim that can increase, this is internal research done by Elliott Management, that can increase dividends by 46% by the end of 2021. And so far, it seems that Crown Castle is willing to work with Elliott Management to achieve that goal. A little bit more long-term, Crown Castle's current strategy, which is kind of a bit of a conflict with Elliott Management, is they want to invest in 5G infrastructure, and they're more focused on 5G infrastructure than their main competitor, American Towers Corp, AMT. And there's a reason for this. So Crown Castle's entire business is in the US, but AMT's majority of their assets are outside North America. And they also focus more, American Tower focus more on larger cell tower facilities and has really made more of a push into the international markets, whereas Crown Castle's only domain is actually in the US. So in the long term, we're seeing a complete investment into the 5G infrastructure necessary for this rollout, but we're also seeing that the company's existing macro cell towers are still going to be very profitable, and they remain vital for handling voice calls data, especially given the rollout of 5G. Which is great. So on to the next slide real quick. So with any good pitch, there's got to be catalysts. We got to see why this is going to make me money in the long run, especially if you're in an interview. Why do we care about this stock, and why should I invest in it? So very quickly, cellular data consumption on smartphones. I was looking at a study in March, was up 70% year over year and 27% month over month. And it's expected that the US will need 800,000 new small cells in the US by 2026 to support the data consumption that we're currently projecting to do. We've also seen that, given the increase in data consumption, telecommunication giants have been keeping the services alive, and they've been maintaining them very well. And we've also seen the deployment of 5G really push forward. And I think one of the biggest catalysts, the reason that I'm talking about this today is we saw on Tuesday that Apple's iPhone 12 will all work on 5G networks. And even given that Tuesday's average price for all the iPhones was 6% lower than last year's new iPhone models. So what Apple's trying to do is set off a super cycle on these 5G phones and hope that there's a long-term transition to the 5G standard, which is very important for Crown Castle, obviously. Specifically with Verizon, who actually got a platform during Tuesday's meeting. Verizon's 5G has almost been exclusively focused on the millimeter wave band, which is Crown Castle's bread and butter. Those are the small cell towers. The problem with them is they have really low range, but they have very, very, very high bandwidth. And it's going to be really, hopefully the industry standard with 5G, that'll make the speeds up to 100 times faster than 4G. But they announced on Tuesday that they're also going to cover 200 million people with low band 5G, which is, comparing to now AT&T and T-Mobile, 5G is definitely becoming the standard. So very quickly, I had a friend of mine also in WIG, Hudson Dorr, created DCF to kind of follow up on Cornell's DCF last week. And I think given the time, I'll forego explaining it, how we did each of the calculations, because last week Cornell did an amazing job. But our projection right now is a long hold 5 years to see kind of the growth of 5G, especially with the Verizon small cell platform and push. And we think a stock price or predicted stock price would be $232, given both the DCF and also an earnings growth multiple. We think is a fair valuation, which is, given that it's 169 right now, great growth that could happen. It's great company invested in for both dividends and also just pure growth given this 5G transition.
All right, that's it. Sorry for keeping everyone a little long. Do people have any quick questions?
I guess I have one quick question. Do you think it would be possible to send out a little follow-up note with the newsletters that you recommend and some of the books? I think you got a lot of really good book recommendations today.
Yeah, that's great. I can definitely do that.
And I guess I have one more question. No one else does. I was wondering if you could speak a little bit to how computer science and using code has helped traders figure out trends they might not have seen in really large data sets.
Yeah, I think that's a good question for Drew. We both are like applied data miners, which is like pretty much applied math using a decent amount of code. And I would say I can't speak to that specifically because he's not a quant either. But it's definitely something that's where we're going in terms of trading, especially in equities and a lot in FX. It's a lot of quant funds doing well in those asset classes. So it's definitely a huge part of trading.
Very interesting.